Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. It's Options Expiration Week, and joining me is Mark Phillips, CEO of Harvested Financial, to discuss why the January options expiration is significant. Mark, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. Yeah, thanks so much for having me here.
Why is the January expiration cycle so significant, and this year, 2021 in particular?
Yeah, it's a great question, and being here on January expiration is, of course, exciting because this is one of those expirations that's been on the books forever. People have been trading the January options for years now, and so what that means is that there's such a high concentration of positions here that when you look at a lot of the dealers out there and how they're positioned, sometimes they have as much as 40, 50, 60% of their inventory sitting in this January expiration. So because these leaps have been on the books for so long, people might have entered in trades 2.5 years ago where, that's either deep in the money, deep out of the money. You can pick a lot of different names and think about where they were 2 years ago, and the options positions are going to be completely scattered across the board. So we see a lot of inventory sitting on the books in January because of that reason in general. So January is always a really active cycle because of the fact that those leaps, L-E-A-P-S, have been on the books for so long. But then this year in particular, I think is interesting because, you've heard me say it before, but there was so much betting on the election and the results of that November outcome. People were betting with November options, December options, and January options too. So this January, the 2021 January options had even more open interest than normal. And so, we're seeing a lot, or I expect to see a lot of interesting activity as the market sort of bounces around and moves between some of these positionings.
So Mark, what signals should we look to in order to prepare for Friday expiration?
Yeah, so a great thing to look at when you're going into expiration is the open interest on a name. And I'll actually pull up my screen really quickly here and show you sort of what I'm talking about in terms of open interest. So what I just pulled up here was, the current open interest for the QQQs. So that's the Nasdaq 100 ETF that for this Friday expiration. And we're sitting right around 315 right now. And it's interesting to look at where the open interest is positioned because that's going to have a lot of effect on the ultimate final price come Friday. So I guess as a bit of review, open interest describes the positioning of market participants. So, when one participant buys a call and one participant sells a call, that creates 1 unit of open interest. So that number is updated every night by the OCC. It's not a dynamic number like volume, but it only happens, at the end of the day, and we get the update of where people are positioned. So this is where dealers are positioned. This is where retail is positioned. This is where any market participant has interest in the market. And so an interesting thing to see, and you can see with some of the lines that I highlighted there, is one of the effects is sort of this round number concentration. So we see a lot of interest at the 310 level. We see a lot of interest at the 315 level. And we see a lot of interest at the 320 level. Part of that is because people like round numbers. People like to think about, a stock going to a specific round number, and that's easy to conceptualize. But another part of that is because of when the strikes are listed. Typically, when strikes are initially listed, they might only list in $5 or $10 increments. So to the extent that these options have been on the books for months and years potentially, that is going to be where some of the early positioning was concentrated at these round numbers. So by monitoring the open interest and where the positioning is, we can look to somewhat predict maybe where the market might close and where the market might find itself in a little bit of a vortex. So one of the kind of interesting features of expiration is how those options decay so quickly in those final days and hours of trading. And so that creates a lot of dynamism in the positions of the dealers out there. So as their Greek risk is changing, their delta and their gamma positions are changing over time as these options expire, to the extent that those are changing significantly on lines with heavy open interest, that's really going to create this effect where their hedging activity is going to be a little bit of that tail of the options market wagging the dog of the equity market. So open interest is a fascinating stat to watch as it really will dictate sort of how people are reacting to market movements.
Mark, that's awesome. Thanks so much for the OI 101 over there. Certainly is a helpful tool. Let's hop off of your slides for now and let's talk about the market sitting near all-time highs. Started off a bit shaky the first couple days of the year, back again all-time highs. What can investors do to manage their positions?
Yeah, it's a great question. I think January is one of those times when everyone starts to think about, okay, new year, new me, new investments. What am I going to do with my money? And, closing in the end of that Santa Claus rally that we saw through the end of December, being at all-time highs poses a lot of questions. And whether it's an all-time high in, an equity index like the Qs, or, we have a lot of people that are sitting on major gains in names like Tesla and a lot of the tech names that are out there that saw fantastic 2020s. So how do you think about handling that? And I'm going to go back to some of those standard benchmark option strategies that, at Harvested Financial are very much our bread and butter and executing them systematically for people. And those are covered calls and collars. They sound pretty boring and vanilla, but there can actually be some really interesting opportunities to manage your risk when the market is sitting at this level. So a good example in the covered call space, would be selling the covered call, selling the at the money, collecting that volatility premium. Vol isn't as cheap as it could possibly get, so you are getting a little bit more premium on that option, and it helps offset some of the downside. So, I was looking at a covered call in Apple, for example, that, the 1 month covered call in Apple, if you're selling that at the money name, is going to generate about 2.5 or 3% of premium for you. So that's not nothing. That offsets some downside. That gives you some cash today in exchange for, the potential upside. But a covered call is one really good way that you can kind of start to buffer and, manage your position when we are sitting at these highs here. And the other one that I'll throw out there that I mentioned is the collar. So, that's kind of adding another leg to the covered call, where you can sell the call and collect that premium, but then instead of, keeping that premium to offset your position, using that to buy the downside put and sort of lock in your gains. And so, there's always really interesting zero cost collar positioning opportunities out there. And given where the market is, and given, depending on what names you're looking at, there are even some collars that will offer some sort of skewed opportunities to the extent that when the calls are very bid up, we have seen in this, active run up that one of the drivers has been a lot of retail call buying, a lot of activity. Those calls, in a funny way, get more expensive than the puts. So you can put on a zero cost collar and actually, not for zero cost, but for an actual credit to you, and give yourself a little bit more upside. And of course, you can adjust the ranges and think about more upside versus more downside, but a collar is a really good way to kind of set in advance for yourself how much gains I'm willing to accept more in exchange for, what I think my risk is on the downside. So, I really encourage investors to look at these simple option strategies that can really make a big difference if you are feeling some trepidation about the market at these levels.
All right, Mark, great stuff as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.